Are you interested in investing in U.S. real estate as a foreigner? Then you are in the right place. I'm attorney Ali Subhan, recipient of the Best Immigration Lawyer Award and Legal Innovator Award. I help foreign entrepreneurs and investors to start businesses in the U.S., obtain an EIN, and open a U.S. bank account in order to invest in U.S. real estate. My firm provides legal advice on business formations, immigration, and taxation. In this video, you're going to learn how to start investing in U.S. real estate as a non-citizen. So let's get started. And make sure to like, comment, and subscribe to this channel. We're going to be publishing new videos every week. Ring the bell so you get notifications every time we release a new video. Now, have you pictured yourself owning a second home or vacation rental property in Miami, San Diego, San Francisco, Austin, Chicago, New York, Honolulu, or another U.S. city? There are many benefits for foreign investors investing in U.S. real estate, including diversification, passive income and cash flow, long-term security and appreciation, wealth preservation and hedge against inflation, leveraged debt to increase return on investment, leverage equity financing to acquire additional investments, and tax advantages including depreciation and cost segregation. According to the Association of Foreign Investors in Real Estate, investors rank America as the best by far for the safety of investing and appreciation. Now, the first step is deciding on the type of property you will be investing in. There are 5 main types of real estate in the U.S. Residential real estate includes single-family homes, duplexes, and multifamily, which includes up to 4 units. Commercial real estate includes office buildings, hotels, malls, apartment buildings, warehouses, farmland, gas stations, restaurants, and other property. Industrial real estate includes property used for manufacturing, production, distribution, research and development, and other property. Raw land includes undeveloped property, vacant land, agricultural lands such as farms, orchards, ranches, and timberland. And special use property includes properties used by the public such as schools, places of worship, government buildings, and other property. Generally, foreign investors that we work with are looking to invest in residential properties that they plan to lease and receive rental income. When we refer to foreign investors, we are referring to investors who are considered non-residents for tax purposes in the U.S. Once you decide on the type of U.S. real estate you'll be investing in, then you'll want to decide on where you want to purchase the property. A foreign investor may choose to invest in any of the 50 U.S. states, territories, possessions, including Puerto Rico, the U.S. Virgin Islands, Guam, American Samoa, the Northern Mariana Islands, and others. One of the most important factors in investing in U.S. real estate for foreigners is choosing the right location. To search for residential properties, I recommend starting with Zillow.com. You can see properties for sale and compare pricing with recently sold properties. To search for commercial properties, I recommend starting with LoopNet.com. Now that you've decided on the type of real estate and the location, your next step is to choose a real estate agent or real estate broker to work with to help you find the property and negotiate the deal. For residential property, you should consider working with a buyer's agent. For commercial property, you should consider working with a business broker. You may also consider hiring a real estate attorney in the state where you plan to make the purchase. Some states require an attorney be physically present at the real estate closing, so check with your real estate agent or broker. Your next consideration will be how to hold title to the U.S. real estate. A foreign investor can hold title in 5 main ways. 1, individually in your own name. 2, through a U.S. LLC. 3, through a U.S. corporation. 4, through a U.S. trust. Or 5, through a foreign corporation. There are 5 main legal and tax considerations that a foreign investor investing in U.S. real estate will want to consider when investing, including taxes on rental income, taxes on sale of property, estate tax exposure, gift tax exposure, and U.S. tax return obligations. Rental income is generally taxed at 30% and is required to be withheld by the person making the payment. If your country has a tax treaty with the U.S., then this tax rate may be reduced. You may be thinking, wow, that's a high tax rate on rental income, and I'd agree. Such 30% withholding tax can result in an extremely disadvantageous tax position if the property has expenses associated with it. Fortunately, a foreign investor can make an election under the Internal Revenue Code, Section 871D, to be able to take deductions and have the net income after expenses taxed at rates starting at 10%. If you make this election, you are exempt from the 30% tax withholding requirement. The 871D election allows foreign investors to claim both rental expenses and depreciation as deductions from gross rental income, thereby lowering the net income and thus lowering their effective tax rate, which could potentially be zero depending on the amount of deductions. By making the 871D election, a foreign investor can take deductions for mortgage interest, depreciation, management fees, taxes, insurance expenses, and other expenses which will reduce the amount of taxable gross rental income. A foreign investor must also consider tax implications when selling the property. When the real estate is sold, you'll be taxed on both the appreciation of the property as well as recapture of the depreciation. If making an 871D election, then each year the property is rented, a depreciation deduction is taken that reduces the current year net taxable income from the property. And the depreciation also reduces the tax basis of the property. When the property is sold, the recaptured depreciation is taxed at a 25% rate. The capital gain, or the appreciation in the property, would be taxed at capital gains rates. Rental property depreciation can be a considerable tax advantage for investors. However, you may be tempted to not claim depreciation, thinking that you'll not be subject to the 25% tax on recapture of depreciation. Unfortunately, even if you do not claim the depreciation, the Internal Revenue Service, also known as the IRS, will calculate the recapture of depreciation tax based on the actual depreciation taken or the amount of legally allowable depreciation that could have been claimed. Upon sale of the property, you will be subject to short-term or long-term capital gains rates, depending on how long you held the property, and you'll also be subject to the recapture depreciation tax. If the property was held for more than 1 year, then the gain would be taxed at long-term capital gains rates of 0%, 15%, or 20%. If the property is held for less than 1 year and the foreign investor realizes a gain upon the sale, then that gain is taxed according to short-term capital gains rates, which are between 10% to 37%. There are ways to defer your capital gains and recapture depreciation taxes on the sale of your property, including 1. Using a 1031 like-kind exchange and then reinvesting in another property. 2nd, own the property through a retirement account, such as a solo 401k, or 3rd, invest the gain in a qualified opportunity fund. Consult with an experienced attorney and tax advisor to learn more about ways to defer taxes on capital gains. A foreign investor must also consider the Foreign Investment in Real Property Tax Act, also known as FIRPTA, when selling a property. FIRPTA imposes a 15% withholding tax on the sale proceeds. Under FIRPTA, the buyer must withhold 15% of the sales price and send it to the IRS, unless an exemption applies or the seller receives a withholding certificate from the IRS. FIRPTA is a mechanism to ensure that the IRS receives any capital gains tax that would be due after the sale. However, rather than waiting for the seller to submit any capital gains tax after the sale, the IRS gets the buyer to submit an advance payment of the tax. If the FIRPTA withholding tax is more than the actual capital gains tax due on the sale, then the foreign investor can request a refund for the difference. If the withholding tax is less than the amount due, then the foreign investor must pay the amount due. FIRPTA applies to a foreign investor holding title in his or her own name, a single-member U.S. LLC where the foreign investor is the sole member, or a foreign partnership, foreign corporation, or foreign entity. One exemption to FIRPTA is if the home is sold for $300,000 or less and the buyer plans on residing in the property for 2 years. FIRPTA also does not apply to a U.S. partnership nor a U.S. LLC taxed as a partnership or corporation, nor a U.S. corporation. However, there are withholding taxes of up to 37% on profits that apply to U.S. partnerships with foreign owners, which may not make this the best option to avoid FIRPTA. Another consideration when investing in U.S. real estate for foreigners is U.S. estate and gift taxes. A non-resident is subject to estate and gift taxes only on U.S. assets. If you pass away and hold certain assets in the U.S., then your estate is subject to U.S. estate and gift taxes on those U.S. assets. The definition for U.S. assets differs for estate tax versus gift tax. For estate tax purposes, U.S. assets include real estate located in the U.S., any U.S. brokerage account holding U.S. stocks and bonds, tangible personal property in the U.S., excluding some art, and stock in U.S. corporations. Cash in a U.S. bank account is not a U.S. asset for estate tax purposes. In contrast, for gift tax purposes, U.S. assets include only real estate located in the U.S. and tangible personal property in the U.S. In contrast to the estate tax rules, cash located in the U.S. is deemed U.S. tangible personal property subject to gift tax. U.S. intangible personal property, such as U.S. stocks and bonds, is not subject to gift tax. The federal estate tax is up to 40% of the value of your estate. The estate of a non-resident is entitled to a $60,000 exclusion from estate taxes. An estate of a non-resident is also entitled to an annual gift tax exclusion for this year of $17,000 per recipient. If married and your spouse is a non-resident, then your spouse is entitled to an annual gift tax exclusion of $175,000 for this year. For example, let's say when you passed that you were married with 3 children and owned one property in the U.S. worth $500,000. Your property was paid for in full and you had no debt on the property. Your taxable estate would be $500,000 minus the $60,000 estate tax exclusion, minus the $17,000 per child, or $51,000, and minus $175,000 for your spouse, for a total taxable estate of $214,000. The $214,000 could be subject to estate taxes up to 40%, or $85,600 in federal estate taxes, plus any estate taxes levied by a U.S. state. Tax treaties can alter the estate and gift tax rules for non-residents, including reducing tax liability. Currently, the U.S. has estate and gift tax treaties in place with 15 countries, including Australia, Austria, Denmark, Finland, France, Germany, Greece, Ireland, Italy, Japan, the Netherlands, Norway, South Africa, Switzerland, and the United Kingdom. One way to avoid estate and gift taxes is by establishing a U.S. domestic asset protection trust, which then owns a U.S. LLC, and the U.S. LLC owns the real estate, brokerage account, etc. This type of structure provides the following benefits: asset protection, estate and succession planning, beneficial long-term capital gains rates, no U.S. filing requirement identifying foreign grantors or beneficiaries, no estate taxes, no gift taxes, no branch profits taxes, and no FIRPTA withholding. Please consult an experienced attorney and tax advisor to discuss the specifics of your case in order to determine the best structure for you and your family. Now let's discuss tax return obligations for foreign investors investing in U.S. real estate. A foreign investor subject to FIRPTA must report the sale of the property by filing a U.S. tax return called IRS Form 1040-NR. In addition, to make an 871D election, a foreign investor will be required to file a statement making the election, along with his or her U.S. tax return. However, some foreign investors do not want to have a tax filing obligation in their own name with the IRS. In that case, one solution would be to create a U.S. blocker corporation. The foreign investor will loan money to the U.S. blocker corporation. The U.S. blocker corporation would form a wholly owned U.S. LLC. The U.S. LLC would then purchase the U.S. real estate and hold title. This type of structure does three main things. First, avoids the 30% withholding requirement. Second, eliminates FIRPTA. And third, removes an individual tax filing obligation for the foreign investor. As you see, there are many things to consider when investing in U.S. real estate, including how you're going to hold title to U.S. real estate and the legal and tax implications of your choice. We recommend that you contact an attorney and tax advisor to help you review which structure would be best for you. Make sure that your attorney and tax advisor are experienced with working with foreigners. Working with an attorney and tax advisor that understands how U.S. laws apply to non-residents is critical. Ask your attorney for references to tax advisors and other professionals to help you. Working with us, you'll have access to our partners, including banks, tax advisors, insurance brokers, and more. Once you have consulted with your attorney and tax advisor and formed your structure, now you'll want to contact an insurance broker to discuss insurance coverage, including homeowners insurance, landlord insurance, gap insurance, title insurance, and other coverages. We also recommend that you discuss obtaining an umbrella policy. Some good insurers in the U.S. are the Hartford Company, Travelers, and others. You should also contact an insurance broker, and they can help you to find the best rates. Google insurance broker and the city you're looking to purchase in to find brokers. For example, Insurance Broker Miami. You can also ask your real estate agent, attorney, and tax advisor for references. Next, you'll want to decide on how you'll pay for the property. Many foreign investors will pay in cash through a wire transfer from their foreign account or U.S. account. However, foreign investors can also access home loans from U.S. banks and private money lenders. For example, U.S. mortgages for foreigners are offered from HSBC Bank and rentalhomefinancing.com. You may also be able to secure a loan through your bank in your home country. Now that you have decided on the type of real estate, chose the location, selected a real estate agent, attorney, and tax advisor, decided on how to hold title, and obtain insurance coverage, it's time to negotiate the deal and make the purchase. We wish you much success in your U.S. real estate investments. We're here to help you every step of the way in investing in U.S. real estate. Contact us to discuss which structure would be the best option for you. Using the right structure can help you legally minimize or eliminate taxes, as well as limit your personal liability and provide asset protection. I hope you found this information helpful. If so, please click the like button and leave a comment below. And make sure to subscribe to this channel to get access to more helpful business and immigration tips and solutions.